Every major economic shift in history created two kinds of people: those who saw it coming and prepared, and those who got swept away by it. The 2008 financial crisis wiped out millions of jobs and savings, but it also made people like Warren Buffett extraordinarily wealthier.
It would be going through the 20,000 pages. And since we were talking about railroads,
Because he understood the cycle and moved accordingly. Right now, the global economy is flashing signals that another major shift is underway. Tariffs are reshaping trade routes. Artificial intelligence is eliminating entire job categories. Inflation is stubborn. Interest rates remain elevated. The question is not whether change is coming, it already arrived. The real question is whether someone is ready to take advantage of it or lose ground because of it. Understanding what is happening economically is not just for Wall Street analysts or hedge fund managers. It is for every working person, every entrepreneur, and every investor who does not want to be blindsided again. The people who thrive through economic transitions are not always the smartest or the luckiest. They are simply the most prepared. Understanding the shift that is already happening before positioning for anything, a clear picture of the current landscape, is essential. The global economy is experiencing what many experts describe as a genuine inflection point. Growth projections from major financial institutions have been revised downward. Global growth is expected to slow from around 3% in 2024 to approximately 1% by 2026. That may sound like a small number, but in economic terms, even a 0.5% shift can trigger layoffs, tighten credit markets, and change which industries grow and which ones shrink. Trade policy has become a central disruptor. Tariffs have reached levels unseen in nearly a century. This is not just a political story. It is a supply chain story, a cost story, and ultimately a job story. Countries and companies that depend heavily on cross-border trade are being forced to rethink everything from where they source materials to where they sell their products. For individuals, this means the company they work for today may look completely different in 3 years. At the same time, artificial intelligence is reshaping the labor market faster than most people anticipated. Roughly 86% of employers now expect AI and data analytics to transform their industries significantly. Estimates suggest that around 92 million roles could be automated in the coming years, while approximately 170 million new roles may emerge by 2030. That sounds balanced on paper. But the gap between which jobs disappear and which jobs get created is where real personal financial risk lies. Entry-level positions, which historically served as the launchpad for long careers, are among the most vulnerable. Elon Musk understood this dynamic years.
I wouldn't, for the prototype at least, I would recommend not dropping anything when you're near it.
Before it became mainstream. He did not just invest in existing industries, he built companies in sectors he believed would dominate the next economic era: electric vehicles, renewable energy, and AI integrated systems. His philosophy was simple: do not defend yesterday's economy. Build a position in tomorrow's. The individuals who protect their financial future through this shift will be the ones who clearly understand what is changing and make deliberate moves, not reactive ones. Building financial resilience before the storm. Once the landscape is understood, the next step is hardening personal finances so that an economic downturn does not wipe out years of progress. This is not about becoming overly conservative. It is about building a foundation strong enough to absorb shocks and flexible enough to take advantage of opportunities when they appear. The first priority is eliminating high-interest debt. When economic conditions tighten, debt becomes a trap. Interest rates remain elevated, and carrying expensive debt into a slowdown is one of the fastest ways to fall behind financially. Ray Dalio, the founder of Bridgewater Associates.
If I could speak to myself in 5 years, I hope that I'd be able to tell myself, you've made the most of it.
One of the world's largest hedge funds has repeatedly emphasized that managing personal debt cycles is just as important as watching macroeconomic cycles. The principle applies to everyone, not just billionaires. The second priority is building a cash buffer. A strong emergency fund, ideally covering 6 to 12 months of core expenses, is not just a safety net, it is optionality. When markets fall or industries contract, cash-ready individuals can make investments, pivot careers, or start businesses at exactly the moment when everyone else is frozen. During the 2008 downturn, investors who held cash were able to purchase assets at generational lows. The ones who had no cash simply waited for recovery. The third priority is diversifying income streams. Relying on a single employer in a shifting economy is a significant vulnerability. This does not mean quitting a job. It means building a secondary income source, whether through freelancing, content creation, a small business, or passive investments, that provides revenue outside the primary paycheck. Oprah Winfrey is a powerful example of this principle.
So when I first started having conversations with families from, different walks of life,
She did not just build a media career. She diversified into production companies, health and wellness businesses, book clubs, and real estate. Each income stream reinforced the others. The result was a financial ecosystem that was resilient against any single industry's contraction. Diversification in an investment portfolio also matters deeply right now. Business investment in AI-related infrastructure is projected to remain strong through at least 2026. Sectors tied to energy transition, healthcare technology, and automation are attracting sustained capital. These are not speculative bubbles. They reflect structural shifts in how the global economy operates. Allocating even a portion of investable assets toward these growth areas while maintaining diversification gives a personal portfolio exposure to the economy's next chapter rather than its last. Investing in skills that survive economic cycles, the single most durable asset any person carries into an economic shift is their skill set. Markets crash, companies downsize, industries fade, but skills that align with the direction the economy is moving cannot be outsourced, automated, or eliminated overnight. The labor market is undergoing the most significant restructuring in decades. AI is not simply automating manual tasks, it is moving into knowledge work, data analysis, content creation, customer service, and even legal and financial roles. The individuals who will remain irreplaceable are those who can work alongside AI effectively, not those who compete against it directly. Learning AI-related tools and data literacy is no longer optional for career longevity. It is a baseline requirement for future relevance. Satya Nadella, CEO of Microsoft.
When a company is successful, one of the things that happens is the concept that got you started in the first place.
Transformed one of the world's most valuable companies by repositioning its entire strategy around cloud computing and artificial intelligence when the business model of the software industry was shifting. He did not wait for the shift to complete. He moved Microsoft into the new era before the old one fully ended. That same instinct, reading the direction of the tide and moving early, is what separates career acceleration from career stagnation in transitional economies. Beyond technology literacy, skills tied to critical thinking, communication, negotiation, and relationship building continue to hold extraordinary value. These are the capabilities that AI currently cannot replicate with full authenticity. The professionals who combine human relational intelligence with technical fluency will be the most sought after in the next economic chapter. Continuous learning must become a lifestyle, not an event. Online certifications, workshops, mentorship relationships, and industry communities all accelerate skill development in ways that traditional education no longer does on its own. The World Economic Forum has noted a significant shift toward continuous workforce learning among top employers globally, reflecting a market reality that one-time education credentials are no longer sufficient in fast-moving economies. Entrepreneurship also becomes a meaningful strategy during economic transitions. When large companies contract, gaps appear in markets. Small, nimble businesses can fill those gaps faster than corporations can restructure to address them. Jeff Bezos launched Amazon during a period of major economic and technological disruption in the mid-1990s.
And so then on sleep, I get 8 hours of sleep. I prioritize it, unless I'm traveling in different times.
He identified where consumer behavior was heading and built infrastructure for that future. Not every entrepreneur needs to build $1 trillion company, but identifying a real gap, building a genuine solution, and executing with consistency creates both income and equity in a world where traditional employment is becoming less stable. The formula for thriving through an economic shift has never really changed. Understand the landscape clearly, build financial resilience that can absorb pressure, invest aggressively in the skills and assets that belong to the next economy, not the last one. The people who do these three things do not merely survive transitions, they use them as the defining opportunity of their financial lives. The next economic shift is not a threat to be feared. For the prepared, it is an opening that most people will miss entirely.